Welcome to the Asset Revolution podcast, where each week your hosts from Arbor Digital provide educational opportunities for financial advisors and individual investors to gain knowledge in this emerging powerhouse that is digital asset investing. The Asset Revolution podcast is your connection to the future of digital assets and an opportunity for anyone to get off zero. Let's dive in. All right, everybody, welcome back to the latest edition of the Asset Revolution podcast. I am extremely excited because it is that time of the year where we do one of our quarterly wrap-ups. So to bridge both the crypto and traditional markets, I have the parts of the team that are both from Arbor Capital Management as well as Arbor Digital. So really quickly, before we dive into everything, in case people don't know you, Matt Schechter, welcome back, sir. Thank you for joining us. Introduce yourself a little bit for the audience.
I'm Matt Schechter. I'm a financial advisor here, or investment advisor with Arbor Capital. I also serve as Chief Investment Officer. Though we have a number of advisors that kind of watch a number of the strategies, I kind of help overarching view, and then I get into the weeds on specific ones, including the equity markets and alternatives and things like that. So that's the brief background.
Beautiful. And as always, I'm sure our audience will not be unfamiliar with the other guests. Matthew Kolesky, welcome back, sir. Thank you for joining.
Thanks, Mark. Thanks for inviting me back. And yeah, I help Matt kind of backstop. Matt can bounce ideas off me, and so we kind of lead the investment committee team. And then, yeah, obviously I'm pretty deep into the digital space as well. So looking forward to the discussion, Mark. Thanks for putting this together.
Yeah, absolutely. And you are not allowed to join Mr. Kolesky unless I invite you. So let's be clear that we have that. I'm just kidding. But so let's get into it. Gents, man, what a crazy quarter, both in the traditional and the crypto world. And there's a lot, I know in the crypto world, there was a lot of good and bad, I guess, if you want to put those value judgments on them. But Matt Schechter, I'd like you to kick us off with the traditional world. What did you see? What happened in Q2? What shaped the quarter?
It's kind of interesting. So there's I guess I'd kind of boil it, if I had to put it into 3 bullet points, I'd kind of say there's kind of 3 things. On the market itself, and specifically the equity markets, I'd almost say we've returned to stupid is kind of the phrase I would use. But what I mean by that is I think there's been a lot of emphasis on what a lot of people call the Magnificent Seven, right? Or whatever, however they phrase it, in terms of Tesla, Nvidia, and those names which have greatly outperformed the market year to date, including the most recent quarter, and are now kind of an ever expanding percentage of the S&P and NASDAQ in terms of their allocations. To the point where if you're owning an index, it's becoming more and more concentrated, seemingly every day. But that's not the whole story, because to the extent that you had some stocks, and I'll just throw out a few as an example, things like Wayfair or Coinbase or whatever. There are other stocks that are up like almost 100% year to date that have literally just rebounded, really not on fundamentals, but on some level of momentum. And so, and even we have speculative stocks within the Arbor portfolio that have been in some of our top performers. And while I think long-term, hopefully those speculative investments work out, sometimes the short-term price movement, you're kind of like, scratching your head a little bit. So I think everybody focuses on 7, but I would actually say in many ways it's somewhat broader than that. And obviously that's reflected in the performance of the NASDAQ, which is up something like 40% year to date, and whereas the S&P is 18 or whatever the number is currently. In the context of that, though, and kind of with all of that going on in the background of the market, there's kind of two macro areas that I'm kind of specifically watching carefully. One is kind of the continued influence on inflation in terms of our economy. And so most people know that the CPI came in below 4 or whatever it was, but it was lower than it was expected. It came off a very difficult 9% comp the year before. We're now getting to the point where the CPI comps actually get tougher. and we'll kind of see how inflation overall, whether it kind of stays sticky within the environment. And this earnings season will be very interesting because we already had Pepsi report, for example, and they had 12% revenue growth, but their volumes were basically flat. So they got double-digit revenue growth, but globally it all came from pricing, right? How we see other companies kind of report in terms of their price versus volume versus mix, to me is kind of how I like to think about things. Costco is another company we know very well. They're seeing inflation in the 3 to 4% range. So kind of taking those data points from the companies and kind of matching it up with the macro to say, like, are we out of the woods with inflation? And I don't know if we are yet. I can tell you gas prices sure seem higher. I don't think labor costs are going down soon, but that's kind of the world that I'm looking at from an inflation standpoint. The last bullet. Yep.
Yeah, real quick. So the first bullet, just to make sure, because that was quite a bit, I want to make sure we keep track of this. So the first bullet point was really around this return to stupid, as you like to call it, with the Magnificent Seven, maybe some tech run-ups. And the second bullet point you went into was the inflationary environment globally. And then now, what's the third bullet point that you mentioned?
The third bullet point, actually, to me, is probably the most interesting, and we're going to start finding it very quickly. And this is actually how much credit the banks are doling out and where loan losses are going. So right now,
and when you say the banks, what are the banks?
That's a range of banks. So a lot of people focus on the big banks. So they think JP Morgan, they think Citibank, they think Wells Fargo, for example.
Too big to fail.
Too big to fail, right? Their customer base from a consumer and commercial background might be a lot different than other banks such as Ally Bank or Discover, or perhaps some of the regional banks, the myriad of publicly traded regional banks that are out there. And so JP Morgan's loans are up this year over year, this past quarter. They acquired First Republic, so there's a little bit of noise in there. Deposits were down slightly, right? But, I think the interesting thing is what's going to be occurring with the banks that are not those kind of too big to fail banks. Have they restricted credit in the last 3 to 6 months tremendously? And, can that have an impact on the economy? So we'll start to see companies report really kind of in earnest on that next week. And we had kind of big three, but there'll be more to come this week and more to come the week after. And those are kind of the three major things, because if we continue to have inflation above where we are, and then we have a significant contraction in consumer and commercial lending, I guess the question is, what might that mean for the markets? Because boy, they don't sure seem to care about anything at this point in time. So that. So if I had to bullet point it, those are the three.
Great, yeah, and we're going to get into what do we do with this information? How what should you be thinking about, and how are we thinking about on behalf of our clients with that backdrop? But before we do that, Matt, I know you're a big macro guy too, and obviously, as you mentioned at the beginning of the call, you along with a few others at Arbor Capital Firm and Matt Schechter serving as the CIO, we have this investment committee that are looking at a lot of different things. Do you have anything to add to that? Anything else that in your mind shaped the quarter?
Yeah, Matt talked about the Magnificent Seven. So I tend to take a different. Sometimes I'll take a philosophical approach to the markets and I like to think what is the market telling us? What does this mean that these 7 companies have either tripled, gone up over 100%, or some of the cases 50, 60%? And I think about these companies that have distributed tech platforms, Apple, Microsoft, right? They're probably in almost, Matt, you might know better than this. I'm sure Microsoft touches over 1 billion people around the world, right, that have access to their software. And so when a new technology comes around, they can instantly deploy that into their network, into their software that is used by hundreds of millions, if not billions. This is Apple and Microsoft. So obviously the big buzz is AI, right? And what that means. By the way, I took my ChatGPT script for this call. I just threw it away. So I'm not a bot, and I'm reading and reacting in real time. And so anyway, I think about that because it's Matt makes a good point, because all these companies have just gone almost parabolic, and Matt used the word stupid because it does feel that way. It's what is going on? To the point where the QQQs are doing another special rebalance, one they've only done 2 other times, right? Those 7 names represent over 55% of the value of the QQQs right now. And so, they're going to,
and just real quick, what's QQQ, Matt, just for the audience?
So the QQQ is a product. I mean, iShares, I don't even know.
Invesco iShares, yes.
QQQ, that really is a representation of the 100 largest companies on the NASDAQ by market capitalization. And it tends to focus on, obviously, on technology for the NASDAQ companies tend to create. But my point is there, it's like, 7 companies representing 55% of this kind of index that is tracked, I'd say second or third to the S&P and the Dow, is pretty substantial. So they're going to rebalance that and remove some of the weighting. And so it is going to move less from a market cap weight to like a market cap-ish weight. And they're going to allocate some of those percentage points to some of the other names. But I go back to the idea, what is this telling us? That these companies have this ability to drive revenue and drive value in ways that I think we have even yet to understand. And that's where, like, these networks, you've got the internet has allowed this to happen, and then you build their own network of distributed technology, right? I've got my iPhone right here. It's like they can just push AI, they can push this stuff to everybody. And there's value in that. And I think the market is partially telling us that. And it can be crazy and it feels insane to some degree. And there's other things that happen. Matt and I talked about this, like the market structure. People are always throwing money into their 401k and they automatically have to buy these. And so it's a little bit of this, effect where you're now buying more. Yeah, you're buying more of the already large companies. And so you need to buy a larger share of them as they go up in price. So it's an interesting point. I just wanted to make that distinction, though, because I think it's a fascinating concept when we think about what are the markets telling us right now.
You talk about network effects, Matt. I use an analogy. There's almost like a pervasive buying network effect.
It is,
which could translate to selling, because between passive ETFs and those mutual funds that are effectively index huggers, you have quant, and then you probably have hedge funds that are chasing performance. So when you have all these confluences of factors that could potentially push the market up, these days it seems like things that don't seem rational can occur for a much longer period of time. And I was, for people internally here, we do quarterly investment committee meetings, and I was sharing with the rest of the Arbor team that, for example, Apple and Microsoft are trading at valuations that are more expensive than they were back in November 2021, when we thought they were, when the Fed basically pivoted and we were kind of at a market peak at that point in time. Some of those stocks are technically more expensive now. And so, if you think about, normal earnings growth relative to valuation growth, things are kind of, on a case specific basis could be more out of whack, and are certainly out of whack with two largest companies on the planet. So how it ends or how it continues, I'm not sure, but I just, we will just adjust accordingly within the firm.
And the last little anecdote I'll share, right? The first $1 trillion company was Apple, right? A few years ago. Now it's a $3 trillion company, and there's 6 or 7 other companies that have eclipsed that market cap in the last, 2 years? I mean, that's an incredible feat where you have companies that are now worth over $1 trillion.
Right.
So and I'm glad you went back into that, Kolesky, because I think for me, when I first heard, our return to stupid, it may sound a little, antagonistic a little bit, but I think the meaning behind that, and Schechter, please correct me if I'm wrong, the return to stupid more just like there isn't a fundamental understanding of the why that these things are happening. Yeah. Why do they deserve to have these valuations or these larger investments? Why do they deserve to be? And I think it's a trend. I think, me being the crypto hippie that I am now, it's a trend you start to see now. Clearly our professionalized systems and learnings about traditional financial markets and economies still are trying to figure out these network effect type businesses that have been enabled by technology and enabled by the internet and enabled by innovation for me. And that's where I'm kind of, I guess, combining both Kolesky and Schechter's points of view. Because I think that's for me, I think it's not real. I guess I tend to less think of it as stupid and more like, okay, clearly something is happening that a lot of people still don't quite understand about these companies that are leading to these things. So let's take that now to go into the crypto land a little bit, to now kind of go over like kind of what shaped crypto markets. And I think for the easy one right off the bat in the quarter was a lot of the regulatory landscape within crypto, both within the US and on a global scale. And I guess to keep it high level, on a global scale, crypto actually is looking very nice. There's been a lot of positive progress with the MICA or MICA, which the European Union actually started going through the progress there. So very good there. In Asia markets, you have a lot of different entities who are now actually trying to set the foundations for digital asset markets to have a positive foundation for them to flourish. So you start to see, Hong Kong has been a big place, and other places like Dubai and other Asian markets where there's been this foundational infrastructure being established for markets to, mature and get to this stage of flourishing. And then I'll switch over now to the US, where the US actually started off in a very, very poor place. You have the SEC, the CFTC, going after both Binance and Coinbase. And a multitude of others. Those are the two biggest players, but there's a multitude of other, actions, enforcement actions, and they're for good reason. Let's get all the bad out. Like, I actually am not that angry about the SEC. Like, I know a lot of people in the crypto world, they're overreaching in a lot of things, but while I do agree with that, there are a lot of really important things that they're getting at that are gonna help in the long run. So I just really caution anybody who listens to this and is listening to this podcast who is more of a crypto native, maybe a crypto hippie like myself, to not villainize or completely turn the SEC or regulators into the enemy, because I actually think they are going to be who we need to go forth. But that's kind of what shaped the crypto markets from a macro environment. Then I would also say more from the technology standpoint. Ethereum had a really big quarter. The Shanghai / Shapella upgrade, making the Ethereum asset more deflationary. And there was a lot of theory since 2021 on the asset ETH and what was going to happen on the network and people using it. And with this transition from proof of work to proof of stake, there was a lot of theory behind it about what was going to happen. But now you're actually seeing a lot of that theory come to fruition, where the ETH asset is becoming more and more progressing as a deflationary asset, which is what its goal was. So that's been really encouraging from and just in terms of ETH the asset. And then Bitcoin, in the Bitcoin world, you had this explosion of BRC20 token standard, which is basically a creation of a whole new set of use cases for the Bitcoin network. Now, whether or not the Bitcoin network is ready for that yet, I think is where we kind of go into there. Mm-hmm. And then obviously, with the banking crisis from Q1 into Q2, I think also, really substantiated Bitcoin's place on a global scale, not just within the US, on a global scale, as this hedge against the traditional world and the banks failing. I think that cemented its use case within a portfolio there as an asset. So it's been a lot of that, and I think just overall, you've seen this flight to safety with taking all that into account. You've seen this flight to safety where stable coins are up, and Bitcoin and Ethereum, really the two most lindy assets, getting more inflows. And there's been this transition from alternative tokens and coins to Bitcoin and Ethereum in this flight to safety. And I think that was just a trend we saw more in Q2. But I would say high level, for me, those are the three main things. But Matt Kolesky, I know you're also in the crypto world, so I'm gonna now pass the ball off to you. What else would you add to what I just mentioned with those 3 bullet points?
Yeah, I'll expand a little bit on the regulatory and even go beyond that in the US. One of them is, the SEC. There is still this idea from a lot of crypto folks and people that work in the digital asset space. We want clarity, we want regulation, and we still don't have that yet, right? When the chairman of the SEC is brought before Congress and is asked if Ethereum is a security, and he can't answer it, but then expects other people to answer it, that doesn't create an environment where people can confidently go out and say, this is or this isn't a security. And then they come through it with enforcement actions against other firms. And we saw the XRP, the Ripple case, where a judge said it's not a security. And so it just casts more doubt, unfortunately, on the market in terms of what is and what isn't a security. And now there's this growing consensus in the U.S. that, yeah, Congress is probably needs to pick this up, because it's not the SEC's jurisdiction to make these determinations. It's Congress that should set the regulatory framework that the agencies, whether that's in finance or whatever, need to abide by, and then they can enforce the rules. They should not be involved in rulemaking. And so that's where there's this growing. In fact, Brian Armstrong from Coinbase today was meeting with Democrats in Congress to say, hey, this is what we are asking for. This is what we need. Because Mark, as you pointed out, Europe is already way ahead of us. They're embracing this and creating a framework for assets to survive and thrive and have clear regulatory frameworks, which we don't have in the United States. And we're starting to see companies, Coinbase, Gemini, right, all the kind of pivot away from the US and say, we're going to go to where we can successfully and with full confidence of compliance operate businesses, and not sit here and get sued and countersued and all this other garbage where that's not productive. It wastes time and energy and resources and time, in the sense that other jurisdictions are moving ahead, right? Mm-hmm. We talked about technology earlier, right? And Mark, you always say, blockchain is just one type of technology. We were talking about AI, or talking about distributed networks and things like that. This is just another piece of technology, something that the United States has in the past done really well. And now we're saying to the markets in the US, maybe you have to go overseas. So that's not great. In terms of, you talked about Ethereum. Yeah, Bitcoin, there's a little kind of a growing wonky, subculture of BRC20, where all this other stuff started ramping up, which, it's kind of fun to watch. But because of what Bitcoin is and how slow it is to upgrade, it's I don't see that happening. It's more like they're testing the next potential use cases of layer 2 on Bitcoin. So people say it's not programmable. It is. It's just a much, much slower process, because they're more focused on security than they are about building all this cool technology and functionality on top of it.
For scalability, yeah.
Yeah.
I totally agree with you there. So now now that we've kind of what happened, right, in the quarter, both traditional and crypto markets, I'd love to kind of now dovetail back to you, Schechter. Now let's talk about, so what do we do with this? We got this information. We kind of set the stage for what happened in Q2. What should the audience, what are we thinking about here at Arbor to do with all of that information?
Gosh, well, start from an equity perspective, and I'll dive actually a little bit into fixed income on it too. From an equity perspective, we don't go out and chase stocks. We generally have a long-term fundamental reason why we're holding an energy stock or a telecommunication stock or whatever we might be holding. So because the market's going rapidly higher for some unknown reason, or is going down significantly, we're not really adjusting our portfolios because of that type of environment, because there are specific reasons we're holding the companies. So when we have in this environment, if we own a number of energy companies and they continue to lag, but we still have some fundamental theory about the Permian Basin, for example, we're not going to actually really do much of anything. In fact, if we're underweight some of those companies because of changes in balances, and we can rebalance and actually add exposure to places where they're now underweight. So that's, so from a consideration standpoint, it may not be, we're going to trade stocks, but it may be, well, do we need to rebalance and give more credence to these value stocks relative to these growth stocks? So that's how I would kind of answer the question on the value, on the value versus growth, and how we think about things going forward. We're not
on the equity side.
Yeah, on the equity side. On the fixed income side, I would actually say it's a little interesting. We have taxable, we have sort of managed fund strategies for both taxable and tax-free bonds, and we're in the middle right now of adjusting some of those investments that we make in various funds for this kind of actively managed bond strategy. And as part of that, there's a little bit lengthening of duration going on. And so within the fixed income strategy that's going on currently. And then even within foundations are kind of our individual, obviously I think everybody kind of well aware of the fact that you can get a 1-year CD for 5%. I don't think that's news. what I think is interesting out there is that if you're looking to source individual mutual bonds, for example, you can get a double A or triple A grade 4% coupon bond near par, right? And without incurring de minimis tax. And so for a client in a high tax bracket, that could be a 6.5% tax equivalent yield or greater, right? So there are options on the fixed income side, both within our foundation strategy, which is more focused on return of capital, relative to some of our more actively managed strategies where you're looking for a combination of return of capital, but there is some element of return expected. So looking forward, I on certainly on the fixed income side, the concept of building a bond ladder. I think we talk about all the craziness that kind of goes on in the financial markets, but I may spend a good portion of every morning trying to figure out how to fill the bond ladder with very high quality, tax-free municipal bonds, which you couldn't do 2 years ago, or not, or even as much a year ago. But with the Fed raising interest rates from 0% to now north of 5% in the span of 18 months, the ability to almost transact on the fixed income side looks to be personally rational. What's going on the equity side, to me, again, doesn't make as much sense. So that's looking forward. That's what I see. Hopefully that answers your question.
No, I think it does, and I think it highlights a few different things. One of those things I would like to linger on a little bit here is this idea of, given the current circumstances and situation within the markets, financial markets, both being equity, fixed income, alternatives, and taking the big picture view, is right now it's actually, there are a lot more places where you can, if you have an active strategy, you can actually demonstrate a lot of value, as opposed to when you have these previous markets where we've been in, where it's just everything is going up in tandem. Right. It's like, okay, yeah, but now when you're in these situations we're in because of, previous, decisions we've had made by certain regulators or whatever the case is, the fact is now what I'm picking up on is that you can actually do some very creative things that can add a lot of value to someone's situation, not just in the equity portions, but using fixed income and alternatives. And obviously alternatives, we have a crypto allocation, and we see many different ways you can do that. And I think the general investor, or the general person who, maybe interacts and does things on their own, doesn't quite understand those things because, obviously they don't live and breathe in this space. And that's kind of the value of an advisor and what they can bring to the table. So I think that's what I'm picking up. But I don't know, maybe I'm just speaking crazy here.
And to the extent that, again, this is kind of the lens that I view it, look through it, is that, whether, Arbor Digital, incredibly speculative, highly volatile, right? Very risky, right? Not unlike, a number of, 3 or 4 of the speculative stocks that we hold on our equity portfolio, right? To the extent 2 years ago that you had that volatility, but you really couldn't play defense with safer investments with, municipal bonds and CDs where you can get decent rate of return. Like 2 years ago, you had no problems being able to play offense, but you couldn't really play any defense, right? And now you can structure a portfolio for clients such that you can play quite a bit of defense, and then it's a question of understanding what their risk tolerance is, whether it's in digital or traditional, to help try and generate returns in kind of that small sliver that might be more risky capital. It feels, in an odd way, it feels a little bit more comfortable to sleep at night knowing you can have a certain percentage of the portfolio playing defense, and then a smaller amount of it playing offense. So,
well, also I think too, maybe the way I'm thinking about it right now, and I think a lot of people, it's almost like you can play offense with your fixed income when generally the accepted practice is you think of using fixed income to play defense. In this type of market structure and understanding those dynamics that we highlighted at the beginning of the call, where we, what's shaping the quarter, you can actually almost play offense with.
If you think about, so I'll show my age. In the days where there used to be defined benefit plans, when companies had to report expected returns on plan assets in the 10K filings that they made annually, and they had to give their assumption for the expected return on plan assets, very oftentimes that's 7%. People seem to people that haven't been around as long and haven't seen financial statement footnotes, that was generally speaking what the long-term expected rate of return was, right? And if you can go to a client and say, listen, like I can give you a certain percentage of your portfolio that is, has a 6.5% tax equivalent yield, or maybe a 5%, 4.5% CD, right? A bond fund that's, a series of bond funds that could earn you 4.5%. Like in my head, you're kind of a long ways towards that 7% return that companies used to disclose in their pension footnotes, right? So those were, and those pension footnotes, they had a mix of equities and fixed income and alternatives and stuff like that too. And so, in a way, and circling a little bit to the Fed, is that with the rates kind of going from 0% to now north of 5%, if the Fed can actually hold, that's a big if, right? Maybe it'll take some time and we kind of get back to what was normal. That could be just completely wishful thinking, right?
Yeah, I don't know if we'll do that, but I think we'll get a new normal for sure. I can at least say that.
But but just to kind of frame reference on what things used to be historically, right?
Yeah, that's a great point. So let's kind of shift over to the alternative conversation, because I think that's a big point. And obviously we are big believers in allocating to alternative assets. But Matt Kolesky, I would like you to kind of kick off this section. So what do we do now, knowing that Q2 was shaped by the things we've talked about so far? Talk to us about alternatives, and we can start with the crypto side there.
Yeah, so I'll talk about crypto in a second. I just wanted to elaborate on one point real quick and maybe offer a slightly different perspective. And this is something that, in terms of rates, and this is something that I think about a lot, and how talking through with individual clients, their situation is so important. What do I mean by that? Well, Matt, you were saying like 4 years ago, right? You could get, 1 or 2%, but inflation was at 3 or 2. So the real return, right, was -1 relative to today. You can get 5, but inflation's at 7, 8. So, the point being, even the headline on a CD at 5 or 5.25 or whatever is great, but when inflation's at 7 or 8, it's still a concern. What do I mean by that? So how do you add value there? Well, then you can talk to people and say, where are you living? Because inflation can be very different in terms of what you're spending money on and where you live. And so you can add value and say, have you thought about potentially, moving here or doing something different to reduce that inflation impact on your nest egg and bring that, that real rate of return more in line. And so when Matt says play defense, and Mark, you're saying playing offense, right? You have that opportunity now with a 5 to 5.5, almost 5.5 on treasuries and CDs, where you haven't had that in the past. Before, it was like you get 1 or 2 and inflation's just there. And so it gives you a little bit more opportunity to do things with fixed income, which is honestly, it sounds boring, but it's kind of exciting. I think, Matt, you might share that. I know it's like, wow, we can actually get return on these things. In terms of no, go ahead.
No, I was going to just say, yes, it very much so. It's just a very good environment to be in if you're looking for specific types of fixed income investments. Yeah.
And in terms of alternatives, Mark, yeah, it's something that we've always been big believers in here, and this goes back to a lot of theory, right? Instead of just having 2 asset classes that are historically have some interesting correlation, we had a third one, right? What we talk about is we don't want this third asset class to correlate with stocks or bonds. We want it to do its own thing, and that over time generally leads to better outcomes for folks. And so what are we seeing here? We've seen in the last year and a half, commodities do really well. We've had managed futures do well, and we're in the process right now, Matt, right, of reviewing our holdings within there, of which digital is one of them, right? And so our thesis still remains, let's have an asset class that people can have exposure to that doesn't correlate with stocks and bonds. And then how can we then be diversified within that, in that area? So that really hasn't changed. what we're looking at now is still the digital side of things. Still seeing opportunity there. We've got, managed futures. We've got mortgage, a little special situations mortgage fund, which I've always found interesting, where they can take, look at lawsuits that are happening in the mortgages, and maybe they're selling at a depressed price, and there's opportunity to create some value there. So again, things that don't correlate with tradition. And this is never, in my opinion, never going to go out of style.
Well, I love that you went there
Yeah.
too, because I think that also now dovetails into me kind of going over, what do we do with this data in more of the crypto lens, right? So, and the interesting thing is, we go out with Arbor Digital. We want to help advisors bring crypto or digital assets to their end clients in a very disciplined and responsible way. But there's still a lot of fear in adopting that approach, and to where we've shifted the conversation from saying, here's this totally new and different thing. And actually, you know what? No, let's talk about it. Let's align first on what we as traditional investment managers, asset managers, financial advisors, whatever you want to call us, where can we both agree upon? And one, if you're looking for a global investment opportunity, if you're an allocator or an advisor who, goes into global markets, one, then great. Two, you're looking for uncorrelated assets. So digital assets, I think that for me in this year in 2023, especially, and then Q2 only exacerbated this, where digital assets or crypto are getting back to what we saw prior to 2021 in terms of correlation metrics, meaning that they are uncorrelated with traditional stocks and bonds. They do have some correlation with, maybe the Magnificent Seven that we're seeing, but a QQQ or a NASDAQ, they still have a pretty low correlation to. So again, global investment opportunity, uncorrelated asset. These are things that any allocator will get behind. So, and then also, I guess the third piece I would say there is, do you want to have an allocation to emerging technology? Like we said here, crypto digital assets, in our view, it's just another allocation towards an emerging technology. And so setting aside the feelings and the cultural aspects to crypto and digital assets, if you're an allocator who is looking for those three things, one of the pieces to that, I think, is a crypto or a digital, I know based on data and evidence now and historically, which is represented, like should be in a portfolio. And so that's where crypto, it's specifically itself, that's what we kind of use it. Now we have a very formulated, it's always been formulated, but now it's just been affirmed. All of the things we've been preaching over the last 3 years or 4 years, 5 years since we've been in and allocating for clients, it's really just been ringing true. And it's been a great narrative and a great story to tell clients when we're sitting there having those conversations to showcase. And then for any advisors who are fearful of investing because of anything happening within the US, given the regulatory landscape, it's a much easier conversation to say, hey, this is a global asset class. So when you invest in a Bitcoin or Ethereum or whatever, insert token here, these aren't just it's not a US based company only contingent on what happens to them in the US. This is a global asset class that you can engage with. So when you see the positive progression on a regulatory landscape, and then, oh, by the way, and this is the last thing I'm going to end with here on the crypto side, is where we ended the quarter with crypto, which is the slew of Bitcoin ETF filings. And then more so than that, when you have BlackRock CEO Larry Fink coming on national television, US national television, and publicly talking about not private blockchain, not, these centralized services, but Bitcoin specifically and distributed ledger technology, and how they're going to transform not just US financial markets, but global financial markets and infrastructure over, the next however many years. That type of, sponsorship, if you will, goes a long way. And I think you saw that with the Bitcoin ETF filings. And then, we're going to see how that plays out. And I would say that this then dovetails now into Q3 and beyond. That's really important to the evolution of, crypto and digital assets overall. So I would say, even though we started off in a very negative space, and even though we still have a lot of, negative or down things that can be considered down, there's a lot of positive to be in with crypto and digital assets.
Mark, I'm glad you mentioned that because I had that on my bullet list, but I get so excited that I missed that. Yeah, the BlackRock ETF application was massive because they put it in, and then I think there was several others that took the language immediately and updated their applications. And we don't need to get into the weeds around that, but yeah, that was a massive move from the largest asset manager in the world. So,
Schechter, you were about to jump in there.
Yeah, the other thing I would just emphasize too is that to the extent that the protocols that are still being worked on and that the security tokens you invest in that relate to those protocols, right, or those businesses that, they're still ongoing with whatever work they're doing, kind of regardless of whether the price has gone hyperbolic or, or down, right? So it's, I've kind of said this in prior, but again, it's sort of how is the underlying business progressing? From a fundamental standpoint, I think about it the same way, whether we've got a really speculative investment or we have a company with simply a very high valuation. I still care about how the business is doing, right? And whether they're working to solve the problems, whether it's, the technology and stuff in the crypto space, or whether it's something fundamental that we've got invested in. And I try to, avoid maybe, I use the phrase return to stupid, but at the same time, sometimes you have to ignore the noise that's going on and simply say, what's going on with the underlying business? And if the business is progressing, then it's just a question of being able to, stomach some amount of volatility in your portfolio as the business proceeds and develops, right? Understanding that there's high risk there. So, that's how I'd view it, whether, we're at incredibly high valuations or incredibly low valuations. So,
and Matt, I pulled up a chart earlier today, and I was you mentioned, this, and I just getting into the industry in the late 90s, early 2000s, and the NASDAQ in about 18 months went up 300%, just as the internet was becoming to,
right.
be a thing, right? And then it crashed, and it took almost 15 years for it to get back to that high that it set in 99. And when you say like return to, like, that's what I think of, like, it was crazy, like pets.com this, .com that, like you put that on it, and it was like ICO days, really, 2017. But it was the traditional tech markets. But it was an interesting time, and I think back on those moments. I can remember the NASDAQ like every day. I'm like, it was going up, 5% a day. Like, what is happening? And are we there again? And it starts to feel like this. And the other thing I say, though, stupid can last for a lot longer than people, it's like that the markets can stay stupid for a long time, because it was almost a year and a half where the markets just kept going up and up and up and up and up. And then it finally popped.
Right. And, in many ways, I was not in the investment community. I was in the corporate world there, but I remember it well. But yeah, when it pops, things were down 80-90%. Even the great businesses, even the companies that turned to be great businesses were down substantially. So, and that kind of goes to a point, where at some point valuation matters. I don't know when.
Right. Exactly.
Don't know when.
But I think valuation matters too at different degrees across different industries and different business models as well. And I think that's where, especially with these new network effect type businesses and with crypto and digital assets, and there's this introduction of new business models, and it's a different way of thinking. And for a lot of people, that's really hard to do. But that's why you need people like us, and not to toot our own horns here, is where we can have people in all the different worlds who can still come together and have a conversation and bring forth ideas without letting the emotions or the culture of it cloud, and we can ignore the noise and really come to some actionable ideas and advice and how we're going to actually maneuver through the different markets, no matter what happens, right? And that's kind of what I really enjoy about us all working together and us all bringing something like this recording to life for anyone who wants to consume it.
Yeah, it's actually interesting. Of all the strategies, the one that I struggle with the most with clients, especially if I'm deploying new capital, is that what if I like a business and it's trading at 35 times forward earnings, and earnings are only going to grow, expected to grow, 13%, right? And it's a good business. It's just not priced right, right? And so that in this environment, that's the pitch I find hard to take a swing at. And so we have allocations to our clients on that. We may not overweight them in those, or when we're thinking about allocations. But that's kind of like in the spectrum of where to, when you have new client money, for example, or current client money, and you're rebalancing, like where do you put things? Like that's the one little area of pocket within Arbor Capital where it's like, okay, like maybe I'll put more in value. Maybe.
So I mean, I love that we're talking about this. This is exactly where I wanted to end up with this conversation here is, okay, so what's the value here? So after listening to all this, if you listen and you're still with us, I think let's kind of sum up what's the one thing that you would have people take away, either looking ahead for Q3, what to pay attention to, or what you think others should be I'll let you decide whether something you're paying attention to or something that you feel, if you're going to go out into the markets, what you should be paying attention to. So Kolesky, I'll start with you. Give us one thing that you think, or something you're going to watch, or something you think others should be watching for in Q3.
I think the big one is the Fed, right? It sounds like they're gonna raise next week, but after that, are we kind of done with these policies of rate hikes? I think you're seeing the market. I said earlier, what is the market telling us? I think the market's already reacting to it and saying they're probably done. That's one of the things that I'll definitely be paying attention to in Q3.
Great. Schechter, how about you?
I think Q3 heading into Q4. So earlier in February, it was February, March, right? We had that big bank shakeup with Silicon Valley Bank and First Republic. We had 4 banks that basically went under. I guess 3 went under and 1 got acquired. Assets got acquired by Morgan.
Largest bank since 2008, right?
Right. So my big thing is kind of what's going on with all the other banks in terms of lending activities and potential for losses, either credit losses, investment losses, in the face of these higher interest rates. And I use a little bit of context from the financial crisis to the extent that when the financial markets melted down with things like not JP Morgan, but Lehman Brothers and stuff like that, that was more of like a 2008, 2009-ish event, right? But the collapses actually started happening earlier with things like subprime, with companies like New Century Financial, which blew up which went bankrupt in 2006. So my point is that we're not going to. My point's not that we're going to repeat that. My point is that sometimes these things take time to play out and actually ripple through the markets. And what I mean by that thing
is, did you just put a pun in there, Schechter?
Probably.
Ripple in there. Oh man, you sneaky one. Sorry, I didn't mean to interrupt. I couldn't not leave that.
Sorry. I'll try and think of another token too to throw in. So yeah, but and that all of that happened, and in the context of Fed rates that were already high, and that they ultimately had to bring down, right, to basically calm the markets and basically save the banks from collapsing, right? But we're in this environment now where you kind of saw like some of these shakier banks kind of fall off the wayside. Now what happens is we kind of move forward with an interest rate environment that's rising, right? And so will there be more problem banks? Could there be consolidation in the banking industry? Could banks fail? And the implications does it matter or not? And so that's what I'm looking for kind of in the next 6 months.
Awesome. And I guess I'll end off with my kind of one thing I'm really paying attention to, and one thing I think everyone should pay attention to is you're going to see events, and there's going to be big events both in the traditional world and in the crypto world. And the major thing you want to be paying attention to is actually yourself. Because what we've seen in the past, and I think both Matt and I and Schechter, who now have decades of experience helping clients and seeing the behaviors over the years, is when we're in scarier or more fearful type of markets, that we see outsized bets or kind of all-in types of behavior when you see positive events start to shift the opposite direction of those fearful things. So I would say the most thing to pay attention to is yourself. And I will say, I'm going to give some advice here real quick. Don't make outsized or risky bets that aren't within your risk parameters based on one singular event. because I think that's going to kind of the thing that's going to be happening over the next year. And I think the prime example, I would say, even we're recording today, it's July 18th. So even though we're a little into Q3 already, I would say I'm already seeing my point proven is with the SEC and the Ripple case kind of getting a judgment from the judge there about SEC not being being a security in some situations and not being a security in other situations. But like you said, Matt, it didn't really provide the clarity that we're all looking for. It only probably created a little bit more confusion. I'd say you don't make outsized bets or allocate or outsized allocations, with, Schechter, you mentioned with, if you have certain, cash on the sideline or any new client dollars coming in, that's the thing I would caution everyone to be very cognizant of going into the next couple of quarters, because there's going to be a lot of enticement. And you said it best, Schechter, ignore the noise. There's going to be a lot of noise, and a lot of things are going to entice you to make outsized bets, to get all in and have those types of behaviors. Having a disciplined action plan that is also responsible, and it's going to be more about setting up that plan and then executing over time, regardless of the noise and regardless of these singular events happening. So I think that's a great place to end here, gentlemen. I really appreciate you coming on and doing this again. I can't wait for next quarter to see what happens after, what we did this one. And apologies, last quarter we did have a little bit of a snafu from a tech side where our last quarter one didn't get through, but I have set it up to where this will not happen for this one. But Schechter, Kolesky, thank you so much for joining me. For everyone else who have joined us and listened, we appreciate you. Be sure to tell somebody today that you care about them, and we will see you on the next quarterly market recap in a few months. Thanks, everybody. We appreciate you listening to this edition of the Asset Revolution podcast. I'm your host, Marc Nichols. Please don't forget to let us know how you like the show by rating and reviewing us on Apple Podcasts or wherever you like to listen. For more downloadable digital asset resources and educational opportunities, please visit us at arbordigital.io. We are here to help you get off zero safely and securely. Thanks again for tuning in, and be sure to tell someone you care about them. Cheers.
Financial advisor, unless you're under contract with or actively speaking with Arbor Capital Management or Arbor Digital, a division of Arbor Capital Management. This podcast is just that, a podcast. It is not financial, legal, or tax advice. If you have individual questions, please reach out.